Hello everyone, I hope you are doing well. So it's been a long time since I didn't do any educational videos, and that's because there was nothing more to add at the time. But recently, past week, I discovered two things. So one thing is from ICT video, and another one is from my backtesting. So I don't know if ICT talked about this type of liquidity or something, but I have discovered this liquidity type and it's very, very powerful. And I also discovered how to trade this, okay? How to take advantage when you can see those type of setups, okay? So the first thing which I discovered is the supply and support and resistance liquidity, or the breaker liquidity. So what does this consist of? Very simple. So you have a break of structure and the price retests the breaker. So the breaker here is a 5-minute candle. Okay. Just remove this one. And you see there is a retest of the breaker and it continues. Okay. And so the day after, this becomes liquidity. Not the day, but it depends on which time do you trade, okay? But this becomes liquidity to be taken, okay? So this, this is a target, but you are not forced, to trade the sell, because you see it's a little sell, even though it provides still 20 pips. So you could trade the sell since we took buy-side liquidity, okay? But that's not the subject of the day. So, this is liquidity, right? So what do you do? Up, sell-side liquidity, okay? And your bias is buy, okay? My bias was buy because I knew this was the target, okay? Mainly the target was here, okay? Buy-side liquidity. But should I buy from there? No, because because we made a retest of this breaker that this is liquidity, okay? Most of the time. You wait for this liquidity to be taken, and after that, of course, you can go into the 1 minute, okay, and see a shift in market structure. For example, this, swing high, break of the swing high, we retest the lower fair value gap and we continue after that. Okay. So you see you had many trade opportunity, many entries, okay, and we reached the top after that. So let's come back. Now there is another thing with this SnR liquidity. You can even snipe the trade. This is what I discovered. Or at least you can know from where you should look for a shift, because personally I was waiting lower first into these gaps, or into, I don't know, 1 hour gap or something like this. Yeah, we reached this 1 hour gap, as you can see, with the Fibonacci 0.5. What is below 0.5? This 1 hour gap, okay? This 1 hour gap. So everything fits, you see, everything fits. We have the discount area, we have the target, which is clearly defined, and you have also the draw on liquidity, which puts more confirmation, more security on your side, because you have taken stop losses. So now the price needs at least to pull back, or do some kind of move on the reverse, so on your side. And then normally you can safely trade from there. Okay, and if it's not the right move, you have the time normally to put at break even or whatever. Okay, so you have the fair value gap, you have the drawn liquidity, and also you have an order block here. Sorry, this little red candle, and I will explain why this is an order block. Order block. Why? Because here you have bullish order flow. Okay, boom. Let's remove this so we can see better. So you have this kind of bullish order flow. Okay. And then we go straight through this, and again straight through this. Okay. Okay, and the order block is right there. So we don't retest neither on the sell side or on the buy side. Okay. So this order block is important because this is the one which was responsible for the last break higher. And so for the take of liquidity higher, we came through it, and again we came through it. And you see, this week does not retest this order block. And this indicates that not only that this is liquidity, but also that very probably this order block is meaningful, because when liquidity accumulates above an order block, it gives importance to that order block, So that's something you must train your eyes, to see it, because even I can miss it, sometimes. And this is very important. So this is the first example of breaker liquidity, or support and resistance liquidity, if you want to call it like this. Does not matter. And this is a second example, the day after. So this was, no, it's not the day after, it's in the same day, but New York session. Okay. So this was London session. Okay, this is Paris time. And this was on the New York session. Okay. But on the New York session, we just have set the liquidity. And this liquidity was taken on Monday. Okay, we had the trade on Monday, and I will explain the trade. So this liquidity, this was a retest of this breaker. Okay, so when you have the retest on Thursday, you can trade this one. Okay, it's only after that it becomes liquidity. But you see, you have a break of structure on Thursday, New York session, New York morning session. You are below 0.5, breaker plus fair value gap. And what is breaker plus fair value gap? Remember, it's a discount area. Discount area because it's old high plus fair value gap. Okay, or breaker if you want to call it. Breaker or old high. Okay, sorry. Up. So this is a discount area which you can trade from. Okay, and then we break the structure. Okay, we take the liquidity, the trend line liquidity, which was there. Okay. And after that, this low becomes supply and resistance, support and resistance liquidity. Okay. Or breaker liquidity. So this low becomes liquidity, right? Let's mark it. sell side liquidity. Okay. Now, here was the trick on Monday. We took the sell side liquidity, but there was no clear break of structure. Okay. No clear. Here you can say it's a break of structure, but it's not. It's just rebalancing a 15-minute, if I remember well. Yeah, 15-minute. And this forms an intermediate term high. Okay. Intermediate term high. So it induced people to buy, and you will see it's a very, very tricky place to trade. And where are we? It was there. Sorry. Remove this alert. Yes, we are going to take the buy side right there. So I will do the replay because it will be much more easier to see. You see, if you wanted to sell from there, boom, stop loss, hit. If you want to buy, boom, stop loss hit, boom, stop loss hit, stop loss hit, stop loss hit again, and then we went down. And that's why it's very important also. The stop loss placement must be very important. I saw this live, intermediate term high. And I remember I took the trade somewhere there. Yeah. And then, of course, I could have went break even many times. But if your stop loss is above there, it is safe. And it is your invalidation point until you take this sell side liquidity. Because the range is not this. They want to make you think the range is this one. But it's not. The real range was from there to there. High to low. This is liquidity inducement trap. Okay. BOS. Now the stop. So the stop loss were there. Okay. Now the stop loss, once you break and take the buy stops, the stop loss are there now. Okay. And this is intermediate term high. This is very powerful, you know, the intermediate term high concept from ICT. It really changed the game, you know, really changed the game. So this is something which I already explained in previous videos, okay? But now let's come back to our support and resistance liquidity, which is there. And remember what I said? I said that there was an area, an order block, which you could trade from. And so what is the closest order block to this liquidity? You could say this is the same than the previous one, you know. It breaks higher, boom, we go through it and we go again through it. But here you could say this week made a retest inside. But also, you can't count this as an order block. Why? Because this order block took this liquidity. Okay? It took this liquidity, then breaks. We form we retest the breaker and form the liquidity, and this is left, and you have liquidity above it, and you have this liquidity also. Okay, so it indicates that this order block is potentially the right one. You know that I don't like to trade order blocks usually, but when I have the supply, the support and resistance liquidity confirmation, and also you could just say this is a rebalance, okay, full rebalance, and boom. But again, this is not a break of structure. They want you to think it's a break of structure because it's impulsive. You know, it's always the same move, but the real range, internal range, was this one, high to low. Retest of, there was a 1 hour for value gap, but I didn't like this retest, to be honest. I prefer this retest on the 15-minute. And yeah, we retested the 1 hour for value gap. We took again the liquidity and we mitigated the middle, kind of the middle of the for value, the order block. Okay. And then we have a shift. People will think it's a sell, okay, because they will trade inside this range. And here they will see a break of structure here, okay, little BOS bot, okay. And so, sorry, stop loss are there, and they took the whole range liquidity, internal liquidity, okay. And I was expecting, I will tell you that this is the second part of the video, which I will explain. I was expecting a swing low, a short-term low on the daily. So I was expecting that. Now we have taken the whole buy-side liquidity, but we want to keep this low protected, okay? We want to keep this low protected. And so you have in the 15-minute, it's pretty clear. Look at this beautiful displacement for value gap. And this is clear, crystal clear shift in market structure again. Okay. You can trade from this. It's not a lot of stop loss. Okay. Yeah, you could say 10 pips stop loss, something like this, a little bit more. It's okay because you know there is a lot of potential. Okay. Let's say you trade from the middle of the fair value gap. Or you could trade on lower time frame, you know, in the 1 minute. I'm sure you could find many entries. And you know, this is liquidity, right? This is liquidity. Up. Stop losses there also. Okay. So from 80 to there, it's already 25 pips. Your percent is done. R2, if you want to keep it, you could aim for much more. And this high is going to be taken, and I will explain why now. Okay, let's remove the drawings because I want you to see something very important. And we will come back to this trade of today right after. So now let's go on the daily. Okay, let's remove all this. Let's keep the chart clean. Let's go on the daily and let's remove all. So the only thing I want you to see is this fair value gap on the daily. You see all the close at the moment are inside. So we are still respecting this fair value gap. We have taken the sell side liquidity, which I was talking about in my reviews. Okay. And now let's talk about another concept, which I saw in ICT video. I will link the video in the description. And now I'm trying to apply this into my daily analysis. So the concept is very simple. He says that you have 3 candles, okay? Let's say a swing low. The swing low is formed, okay? And now this the high of the third candle, which forms the swing low, is liquidity. So this is, in this case, it is buy-side liquidity, okay? And therefore, even though the high might be there, the close of the candle might be there, you know, the candle close. And the next day, you open right there, okay? And so your target will be the buy-side liquidity, okay? And this is exactly what is happening today, or I hope at least. I'm projecting this to happen today, and I will explain live what I mean. So you have a short-term low, okay? And here, or you can say this is a short-term low. Okay, let's put it short-term low. And you have this, which is intermediate term low potentially, okay? Potential intermediate term low. That's why I said protected, but let's call it potential intermediate term low. Okay, remember a swing low, it has a higher low on the left and a higher low on the right. Okay, same thing here. Okay, and here I wanted, so I first expected this to be, you know, the short-term low, and we make, you know, a higher low, but this was not the case. However, yesterday, sorry, not yesterday, 2 days before and yesterday, we respected this low. So this is a short-term low on the daily, confirmed short-term low. Now we have one short-term low on the left, the intermediate term low, and a confirmed short-term low on the right. So this means this is intermediate term low, confirmed, okay? Confirmed intermediate term low, okay? Now, if we follow ICT's logic on the swing low liquidity, this is the liquidity, okay? This is the first candle, okay? This is the second candle. This is the third candle, sorry, okay? And the high of this candle is the liquidity, right? Now that you know where is the liquidity, should you buy right from the open? No. Let's see what happens here. You have a range. So this is the weekly opening price, which adds even more to the fact that you trade from the right place. This is the range, okay? Microstructure continuation range. So the dealing range, if you prefer. The equilibrium is right there. Let's remove it. So we have the equilibrium, okay? We have also a very beautiful fair value gap, which broke all this liquidity displacement fair value gap in 5 minutes. Very beautiful. And above this fair value gap, what is very beautiful also is the sell side liquidity. Okay, this is sell side liquidity. And so at the Frankfurt opening, we break higher. We induce people to buy. Okay, BOS. Where is the BOS? Boom. We induce people to buy. Stop loss are all there. Okay. You are not forced to trade the sell. I didn't see if there was an entry. So you see no proper entry for the sell. You could say, yeah, this one maybe, but it's too short, you know. It's only 10 pips from there to there, so it's not worth it. So, you know, you don't have to trade all the moves, and I don't recommend it because you can get lost and you can miss the right move just because you are forcing with the profits of the sell, you know. That's why I always recommend to wait for the right move. And the right move is pretty clear. Nothing more clear than this. Draw on liquidity. Okay. For value, you trade from an important area, which is the fair value gap, which created the displacement. Okay. And if you want, you can wait for a shift in market structure. Not if you want, it's the third step of the strategy. And also you are below midnight opening and you are below equilibrium. Okay, every single lines. It's pretty clear. Every single lines. And you wait for a break of structure, a shift in market structure. You can either wait for this, but you see no retest, or I would prefer to wait for this high to be broken, sorry. Because this high is more clear than those little, you know, or at least this one, because this one was responsible for the move which took the liquidity. Sorry, it's not BOS, it's a shift. So you could trade either directly from there, but since the stop loss is big, I think 11, yeah, 10 pips, it's okay. But if you want to trade with a tighter stop loss, you wait for something better. What is something better? So you could wait for an intermediate term high. Okay, this is short-term high, intermediate term high confirmed by this fair value gap, which broke the structure. Okay, and what I like is we didn't take the first buy side liquidity, so you are still safe to enter the trade. Okay, you enter from there, stop loss below the intermediate term low should be protected. Okay, if this is intermediate term low, people will wait to buy from there, or from this order block, but they won't get the opportunity. And even there, we don't retest. And I love this price action because this is clear. It does not give an entry to everyone, so you can feel more secure, you know. Here, it takes the liquidity of this order block for people who FOMO people, you know, fear of missing out. We take the liquidity and it trades. It does not come until the order block. It trades from the fair value gap, so even more perfect. So you have first intermediate term low, then again intermediate term low, then again intermediate term low. So you see, pretty clear. And even there we make almost 20 pips, but from there we make it, you know. From there, yeah, kind of. But to be honest, at this point, you can hold the trade. You can hold because I expect if ICT's method is good to take this high. And I really believe we will take this high because a lot of liquidity must be sitting above, you know, even on the lower time frame. However, it might come back to break even, but I don't think so personally. I think we have just retested this 5-minute fair value gap, which took displacement, you know, and took the high. And I think now we might go take the liquidity. Okay. And so let's come back to the concept, okay, of the daily swing. Let's remove every drawing. Once you have your bias, okay, so let's say now, boom, this is set. Okay, you want to sell, you know, this is the area. Sorry. Of course, if I put one area, so you know this is the sell side. Okay, let's remove now. You know this is the sell side. You wait for swing high to form on the daily. So first you wait for a break. This is a clear break, right? Now you have a swing high. So this low is liquidity. Sorry. Each time I draw something. So this low becomes liquidity. Again, another swing high. Okay, 3 candles. This low is liquidity. Again, another swing high. This low is liquidity. And until we take, of course, this, we have, now that we have taken, you wait for a shift. So this swing high has been taken now. And now we must rely on the swing lows. So you have the first swing low. And since we have another swing low on the right, the left, you can expect this one to be intermediate term low. But you need confirmation. If you don't have confirmation, it's not good unless this would have been confirmed if we made a big move with a fair value gap, you know, but we don't have a fair value gap. Therefore, now we must wait a confirmation. If you remember, intermediate term high, it is confirmed in two ways. So it's either, I'm trying to, okay, it's either you have like a big move with fair value gap, which confirms that this is intermediate term low, and then you can trade from the retest, or you don't have a fair value gap, so you wait for a confirmation, another swing low on the right. Okay, and this is what I did. I waited for a swing low. So of course you have to wait on the daily, but yeah, the price can be very messy, so it's okay, you know. And yeah, so just backtest this. Okay, just backtest it. You can see swing low. This becomes liquidity. We didn't take it right after, but we found another swing low. Okay, we take it. Swing low, we take the liquidity. Swing low, we take the liquidity, etc., etc. You know, I've backtested it. It's pretty clean. And the thing is, when a swing low form, I don't know, I will find an example like this one with a little wick, it leaves no room, you know, for a trade. Usually in Asia, it will take it already. Okay. Sorry, for example, swing low. Yeah, for example, this one, you know, the close of the candle of the swing low is there. The buy side is there. There is no room, you know, boom. But when you have like today, a close which leaves how many pips? 40 pips, something like this. You have room to take the trade and aim for the buy side, you know. You have room. You see, you trade from there, let's say from 0.7, okay, to 40, almost 40 pips, okay. So if you have at least 20 pips, for me, it's a good trade. If it's less than 20 pips, it might be not worth it, you know, to take. So now I'm gonna end the video, and hopefully you find this educational video insightful, and hopefully it will give you many opportunities. But just be very careful, because especially about the support and resistance liquidity, because you can see it everywhere, and you must not trade from everywhere, you know. You can have many losses, you know, like every other concept. You might be saying, I don't know, for this one is valid because you trade from the breaker, this becomes liquidity, and after that it goes below. But you can find as this one, you see. So here it could be valid because we still have a move, but you see it's not the right direction. So be very careful with the concept I'm sharing with you, because like the fair value gap, you can see fair value gap everywhere, you know. You can trade from there, boom, you get stop loss hit. You can trade from this one, stop loss hit. It's not because the concept work with a certain strategy that it will work if you trade randomly, you know. Fair value gaps, there are everywhere, and the breaker liquidity, you can see it everywhere also. Okay, so just a warning. Always look for the three things which I'm telling you. First, you want to know the target. The target for me, since I open my eyes, it's there. So you know the direction. Second things, you want to trade from a proper area, from a discount area if it's a buy. You know it's a buy, discount area. You look for an area below equilibrium, below midnight. It will not always be like this, you know, aligned with all this. Sometimes it will be below equilibrium, but above midnight, or, you know, the reverse. The thing is just to find a clean area where you can trade from, and which you can say it is a discount. This is a discount. Why? Because even though if you trade this internal structure, microstructure, you are in a discount, okay? And even you see the discount price is at the exact same level than the weekly opening price. So everything aligns in this trade, and you have a draw on liquidity. This is very important also. ICT always talk about this, draw on liquidity. And in my way of trading, it's important also because this is what sets the stop losses above, okay, in the algorithm. This is an inducement. So people are induced to sell. You have a discount area, and then you wait for the shift. And you see, even though you can trade on the 5 minute, you trade from this fair value gap, okay, you put to 10 pip stop loss, shouldn't come back even to there, you know. Yeah, 10 pip stop loss, because you know you have 30 pips, so it's R3 from there. Even if you trade just the week, okay, from this week to there, you have room. When you know your exit, you can be much more confident for your entries. While if you focus on the entry and you don't know where is your exit, you will see it will create many problems. And we traders, when we start in this journey, we are always focusing on the entry, you know, sniper entry, you know, with the smiley, with the money, you know. we don't care about sniping entries. What we care about is the direction. We know where the price is heading to. You know, I bet whatever you want, it will come until there, you know, and take the stop loss. You care about the direction, so the exit first, then you care about your entry, the area of your entry, not the entry itself. So here is the area, and then, only then, you can look for the entry, for the shift, you know. So it's the last thing to look for, you know, the sniper entry or whatever. So you see many people on Instagram, you know, they have trades everywhere, sniping entries, yeah, you know, from there and from there and from there and from, you know, they snipe every move, you know, but they show you only the wins. You know, they put their MetaTrader 4, you know, MT4, you know, you have the limit, and they raise, you know, the lots, etc., and the order, just to show you that they have, you know, a boost in their ego, you know, to show you that they have a sniper entry. But they don't show you how many losses they have taken before, you know, sniping all those entries. And this can be very discouraging. And that's why I recommend everyone to remove the social medias. Because not only this is a distraction, but also it can be very frustrating. If you had a losing day, believe me, even myself, if I have a losing day and I see on Instagram or Telegram or whatever gram you are in, you see someone else winning, it is very bad feeling, very frustrating, you know. It's not good for yourself and not good for your trading. While if you are focused only on your trading, there is no competition, nothing except you being better from day to day, you know. You don't look at anyone else. And if you just follow ICT or my videos, normally you have enough knowledge. You don't need to look for any other videos. No one else, no one else. Because there are many, many videos on YouTube which, you know, they retake the concept from ICT and they will resell you the same stuff. But it's still ICT stuff, you know. Most of what I'm using is from ICT. So even though I might explain it differently or might understand it differently, it's still ICT stuff. And I think if you watch most of his videos, you will get more knowledge, you know, more, I don't know, insight, you know. And so, yeah, just focus on yourself, remove the distraction, remove social medias, and you will thank me later for this advice. Don't focus on entries, focus on exits first. Direction, bias. Thanks for watching, and see you later. Trade safe, trade mindlessly.